Hey everybody, welcome back to the Optometry Money Podcast, where we're helping ODs all over the country make better and better decisions around their money, their careers, and their practices. I am your host, Evon Mendrin, certified financial planner and owner of Optometry Wealth Advisors, an independent financial planning firm just for optometrists nationwide. Thank you so much for listening. Really appreciate your time and attention today. And it's May already. And at this time of the year, in April especially, and also going into May client meetings, I am reviewing client portfolios for rebalancing opportunities to make sure there's enough cash for upcoming cash needs or that they're allocated properly. Just sort of a quick review of all the accounts, although there's not typically too much activity that's happening, mostly just sort of investing their regular contributions. But this is that time of year where I take a quick look at that. And in that theme, I wanted to start a series of investment-focused episodes, starting with the fundamentals, which would be today's episode, and then adding more and more information and context and details as we go and into different topics. And there are a lot of ways to build wealth for an optometrist, and in a lot of ways to invest your dollars and your time as an optometrist. There's practice ownership or other private business ownership. There's side businesses. There's privately held rental real estate. This series is going to be focused, when we talk about investments, on publicly traded financial assets. So things that you'll commonly find in the most common investment accounts like 401ks, IRAs, HSAs, taxable brokerage accounts. These are the most common and really easily accessible forms of investing. And I've personally seen many people successfully build substantial wealth and successful retirements using these investment options. And they can be truly passive investments too, meaning that even if you own a stock, for example, well, you're not on the board, you're not an executive, you're not an employee in that business. You are allowing that board and the executives in that business and the employees to run the business, and you just accept the returns. It's truly a passive investment and allows you to focus on your own business or your own patient practice, your own family and community, whatever it may be. And on today's episode, I'm going to talk about the fundamentals about what are stocks and bonds and even REITs, real estate investment trusts. And we'll dive into what mutual funds and ETFs, exchange-traded funds, are and how they work and some of the different things to look out for when investing in mutual funds. So I want to sort of build the basics around things that you're investing in and all these different accounts you have. And over the next few episodes, we'll talk about how to pick what mix or what percentage of your investment should be in stock or equity type investments versus bonds. We'll talk about whether you should invest in passive style investments versus actively managed investments, or is there a difference? So we'll start to build on to different categories here. So as far as today's episode, let's go ahead and dive in. And let's start with, what are publicly traded stocks and bonds? Well, every business needs to have ways to raise capital outside of just the revenue and the profit that it generates. You think about a private optometry practice. When you cold start, for example, to get that practice up and running, you're going to need to raise capital. You can either put your own money into the business, you can invest in the business and in return receive stock if it's a corporation, or you can get other investors, family, friends, or you can go to a bank and get lending, which is typically what happens as a part of a cold start. And by the way, that's the same if you're purchasing into a practice. You can have your own dollars that you can put into the purchase, and in exchange, you're going to get equity, you're going to get stock, or you're going to go to get lending, and that lender is going to allow you to do that. So these big publicly traded businesses sort of work that same way. They raise capital by either issuing stock, and investors purchase the stock and give the company cash, or they can borrow. And a major way that these large companies borrow is by issuing and selling bonds. Countries, while they can't sell equity, right? You can't invest in the United States of America. They can also borrow money by issuing and selling bonds. The US, for example, issues treasuries of different maturities, different lengths of debt. And that debt is a liability on the US balance sheet, but it's an asset on the balance sheet of you or me or whoever owns it. Municipalities like states or school districts, they issue bonds as well. So common stock are partial ownership in a business. It's equity ownership. For example, what are some common companies? Apple, Meta, Nestle, whatever it may be, right? So when you are investing in the stock market, in stocks, you are buying partial ownership in actual businesses, right? It's not hocus pocus. It's not just numbers on a screen. You are purchasing legitimately partial shares of real businesses. And when you purchase stocks, you theoretically, as an owner, have a right to future profits of the business. You generally, for common stock, have voting rights, although it depends on the class of stock you have. If you own stocks individually, you may get a bunch of proxy voting materials in the mail each year. And you enjoy the growth of that business as well as the declines of that business. And just like an optometry practice, you get the return of stocks in two ways. There's the increase in the price of the stock, so that's capital gains. And then there's the dividends, which is the board deciding to share and distribute profit back to you, the shareholder. Unlike your optometry practice, these stocks are traded on, or they're traded publicly, either on public exchanges like the New York Stock Exchange or NASDAQ in the US, or depending on the company, they could be traded over the counter, which is between brokers, a network of brokers themselves. And you can buy and sell these stocks through a broker like Schwab or Vanguard, Fidelity. If you have an account there, you can go to the website online, find the stock you want to buy, click buy, and that broker will go to the exchange and will execute that for you. Or maybe you've seen, like in the past or still today, like a rep at a financial institution that you can call up or email, and they'll get the buy and sell order from you, and they'll do that for you for a commission. And so you'll do that through a broker. You'll access these exchanges through that broker. And because they're publicly traded, they are regulated by the SEC and have a whole list of requirements to provide a transparent information to the public, like financial statements, quarterly, annually, trading activity of insiders, executives, and so on. So all this information is publicly known. And these stocks have different characteristics. So there's geography, of course. It's in the United States or international companies or emerging markets. There's the size components of that business. So it's large cap or large capitalization. It just means the value's high. There's mid or even small cap, smaller companies in the millions, right? So these aren't like a cold start optometry practice. These are still in the millions and millions of dollars of value. And also characteristics like value, which means that the price is lower relative to certain fundamental metrics like earnings or cash flow or equity on the balance sheet, or growth even, which is the opposite. It's a much higher price relative to these financial metrics. So there's different characteristics like that too. And when you buy or sell stocks, there are specific costs to keep in mind. The first thing is a commission, right? Which are the explicit cost you see when buying or selling something, like $9.99 a share or something like that. And these have pretty much been eliminated, or at least have started to be eliminated over the last few years. Several brokers, I think Robinhood, Schwab, TD Ameritrade, for example, I believe, have made trading free, right? So they've made that free. But then those are the explicit costs, much of which have gone away with many major brokers. But there's also implicit costs that you don't actually see, but still impact the returns. Number one is what's called a bid-ask spread. So that's the difference between what you're able to sell a share for and what you're able to buy that same share for. Because when you look at a stock price, yes, you see a price, but if you actually look, there's a bid price, which is the price that you can sell that share, or the ask price, which is the price that you can buy that share. And there's a difference between those two. And that difference is what's basically kept by the institution, the middleman, that facilitates all these transactions, sort of the market maker on these exchanges. And those market makers, those middlemen, allow the plumbing of all these transactions to continue running, to not get clogged, so to speak. They facilitate the buy and sell orders of the brokers. They buy and sell their own inventory to keep these transactions flowing. So they sort of make these markets, and in return, they keep the difference between what you can buy a stock for versus what you can sell that same stock. And in these public exchanges where there's a lot of activity, the market's consistently working, there's good, steady volume, those spreads are really small, maybe a few cents. But for that middleman market maker, if you spread out a few cents over, how many millions of dollars per day, that can add up to quite a lot. So there's those bid-ask spreads. There's also price effects, which is how the volume of buys and sells impacts the price, either downward or upward. And these are implicit costs, which you don't see explicitly as you would a commission, but they do impact your returns, because if you buy something at a higher cost than you could have otherwise, or if you sell something at a lower price than you could have otherwise, well, that's going to impact your returns. Whether you're individually buying these securities yourself, or whether you're using a mutual fund that's doing that for you, you want to make sure that there's a process, or at least a thought to managing those spreads really well. And so those are stocks, partial ownership in businesses. And of course, when a company initially wants to raise capital through these public markets, that initial sale is going to be through an initial public offering, an IPO. But usually when we're buying and selling stocks on an everyday basis, you're going to do that through the secondary market, which is just through other institutions, other people, not directly from the business itself. And what about bonds? So as we mentioned earlier, bonds are a form of debt. And when you buy a bond from a corporation or a country, you are essentially lending money to that company or country. And in exchange, you receive interest, often, for example, every 6 months. And then when it matures, you receive the final interest payment plus your money back. Bonds don't trade on exchanges like stocks do. They trade over the counter. So your broker is going to be working with other brokers to find the best price for buying or selling a particular bond. And there are many types of bonds. There's corporate bonds, national or government bonds like U.S. Treasuries. The shortest term U.S. debt is going to be Treasury bills. The sort of medium term is going to be Treasury notes, and the longest term is going to be Treasury bonds. And there's also municipal bonds, like we mentioned earlier, whether it's the state of California or certain counties or school districts, municipal bonds. And they all have differences in how the interest is taxed if you were to hold them in taxable investment accounts as well. There's different maturities, so they can be 1 month, 1 year, 10 years, 30 years. They can have different credit ratings, which are measures of the creditworthiness of that company or country. And that credit rating, which, the best rating is what we would consider investment grade. Sometimes you'll see, depending on the rating agency, like AAA, AA, whatever that may be, this credit rating should reflect the risk of default, which you'll often also see reflected in the interest rate. Higher risk should demand a higher yield. So high yield or junk bonds are examples of this. So those are bonds. Those are a form of debt. You are essentially lending. You can buy them directly from the U.S. government on the Treasury Direct website, or you can buy them over the counter from other people, institutions, through your broker. So let's say that you didn't want to buy all these different stocks or bonds individually, all by yourself. In fact, I typically recommend not trading individual investments, individual securities. Instead, I'll use or recommend mutual fund or ETFs, exchange traded funds. And typically what you're going to see in different accounts like your 401k, your simple IRA are going to be mutual funds. And so let's start with mutual funds. What are mutual funds? Well, mutual funds are a basket or a bunch of investments all in one wrapper. If you've ever been to Costco, if you've ever been to the store Costco, something when I go to Costco, it gets me every single time is a tub of pub mix, which is just a mix of a whole bunch of different delicious salty snacks that I can't keep my hands off of. And rather than me having to go buy every individual little snack piece, all the different pretzels, all the different cheesy bread things, all the different whatever it is, and then mix them together myself, I can buy this tub of pub mix and have that whole mix of snacks inside of the tub, right? Now, think of your investments, your mutual funds in that same way. It's an investment company that pulls together a bunch of investors' funds, and the manager of that fund, that mutual fund, invests all the funds together in whatever the strategy of that fund is. And you, as the owner of the mutual fund shares, you indirectly own everything that's inside of the fund. So you directly benefit from all of that investment activity that's happening. This allows you to be instantly diversified, meaning instead of you having to go buy every individual security, it allows you to indirectly be instantly diversified. It allows you to take the work off of your shoulders of the buying and selling activity of the investments, and to do so in a way that's liquid, meaning you can redeem your shares, you can sell your shares of the mutual fund and receive cash back, in one day. And there are different types of mutual funds. So there are mutual funds that invest in stocks. So you own a bunch of stocks inside of the fund. It could be just U.S. stocks, international stocks. It could be different type of stocks like U.S. large cap value, U.S. small cap value. But there can also be different investment approaches inside of the fund. So there could be actively managed mutual funds where that manager has an active investment philosophy and strategy, and they're trying to trade and buy and sell the individual securities that they expect to outperform whatever it may be, to find mispricings in the market or to time the market, whatever it may be. So there's actively managed funds with an active investment strategy, or it can be a passively managed mutual fund. And passive style mutual funds are, rather than having an active manager that has an active investment strategy trying to outperform whatever the benchmark may be, passive style funds are going to trade on a set of transparent, consistent, systematic set of rules. And index funds are a really great example of that. Index funds will trade and try to match an index, which is just a list of stocks or bonds or real estate investment trusts based on however that index provider creates the list. So passive investments are going to tend to be pretty broadly diversified. They're usually going to try to give you exposure or ownership over a broad market or an entire category of companies or an entire category of bonds. So, and there tends to be less trading activity and tends to be lower cost. And there can also be bond mutual funds, so investing in different types of bonds. And there can also be blended mutual funds, which is a mix of all of the above. And mutual funds, in order to keep their status as mutual funds, are required to distribute the investment income and the net capital gains out to you, the shareholder, so they can't retain all that inside of the fund, which means that if you hold mutual funds inside of a taxable brokerage account, which is, again, not a retirement account, the interest and dividends and capital gains from the trading inside of that fund are distributed out to you, the shareholder, and end up on your tax return in that year. Inside of a retirement account, of course, it doesn't matter. Right? You're not taxed on any of that growth or income inside of that retirement account. It sort of stays within that bubble, which is a reason that active managers tend to be generally less tax efficient than passive type of mutual funds, because there tends to be less trading in passive funds than in active funds. And there are different types of share classes of mutual funds to keep an eye on, meaning that they invest in the same thing, but there are different cost structures. There are two costs involved in mutual funds that you want to keep an eye on. Number one is an annual expense ratio, which are published publicly. You can go check that out for any mutual fund. That is the annual cost that's going to come out of the fund, and that's going to impact the returns. And there's also a type of commission when you buy the fund or even when you sell the fund sometimes, depending on the share class. Sometimes you call that commission a load, for example, a front load. Other times your broker may charge you a certain dollar amount to transact in mutual funds, similar to how they may pay you to transact in stocks. And the two types of mutual fund shares you want to keep an eye on are A shares or C shares. And if you're ever talking or working with like a broker or a registered representative at a big financial company, these type of share classes probably will come up. And an A share is a type of mutual fund share that whenever you buy it, you're going to see a commission come out of your purchase right off the bat. And that's sometimes called a front load. And that's as high as, I've seen it as high as like 5.5% on stock mutual funds, maybe a little bit lower when you get to bond mutual funds or something similar like that. So I think within that range right off the bat when you purchase the fund. And then on top of that, there's going to be an ongoing expense ratio. And that commission and that part of that expense ratio goes into paying that broker or representative and helping that company market these mutual funds. And so that's an A share. And on the C shares, the difference between an A and a C share is that on a C share, there's no commission or load when you purchase the fund. However, there is a higher annual expense ratio. So they make up for it if you keep the fund and over the years. However, there may be a charge when you sell the fund, if you sell that C share within the first year of ownership. So A share, you get a commission right off the bat when you buy it. C shares, you get that higher annual expense ratio, and then they get you on the back end if you sell it within that first year. And I don't know why these two type of share classes still exist. I mean, you can buy so many without a front load or without that commission. There's a ton of no load funds, no commission mutual funds out there that you can buy pretty easily. I just don't know why these exist anymore other than to pay brokers for selling them and to help that mutual fund company market them. So I would personally avoid these altogether if you can. If you're in a 401k, typically you're going to see either institutional type shares or R-class shares where you don't have those commissions. Annual expenses tend to be a lot lower. I mean, you're buying in bulk in a 401k, so there's economies of scale. And then oftentimes like those no-load mutual funds are available out there, or institutional type funds are available out there with lower annual costs. So just keep an eye out for those A and C shares and try, if as much as you can, to buy mutual funds without that front commission, because they are definitely available. There's really no need for you to pay that anymore. So that's a mutual fund. And then there's the ETF, which is similar but different. So an ETF, an exchange traded fund, has essentially the same purpose and concept as a mutual fund with a few important differences. So an ETF, an exchange traded fund, is a pooled basket of investments, just like a mutual fund. In fact, you can have a mutual fund and an ETF that invest in the exact same way. And they can own the exact same things underneath. They're just in different wrappers. In fact, some fund companies have an ETF and a mutual fund that are literally the exact same investments underneath. So going back to my pub mix example, I mean, it's like buying the pub mix in a plastic container versus an aluminum container. It's still the same pub mix underneath, still the same delicious salty snacks underneath, just different containers, different wrappers. Unlike mutual funds, ETFs trade on the exchange throughout the day, similar to a stock. When you buy a mutual fund, when you actually click buy or sell, that transaction actually happens at the end of the day. At the end of the market close, at whatever value that funds end up being at the end of the day. However, you can buy an ETF throughout the day, at whatever that market price is throughout the trading day. Another difference between ETFs and mutual funds is that you have to buy whole shares of ETFs, like 1 share, 10 shares, 30 shares. With a mutual fund, you can actually buy down to the penny, right? So you can buy, 32.01523 of a mutual fund share. You can buy based on the amount of money that you're using. With an ETF, you can't do that. You have to buy whole shares. Which is part of the reason why you're not going to find ETFs that often inside of 401ks. You're typically going to find mutual funds in a 401k because those regular contributions are based on dollar amounts. the structure of ETFs are different than mutual funds. And this is important because it tends to make them more tax efficient when you use them in a taxable investment account. And part of the reason for that, when you look at a mutual fund, right, it's a pulling together of a bunch of investors' dollars. That mutual fund manager is investing it. And sometimes investors need to redeem their shares. So they tell the mutual fund, hey, I'm redeeming my shares. That's basically what a sell order is for a mutual fund. I'm redeeming my shares, give me cash back. And typically a mutual fund manager is able to manage that flow of cash well enough, meaning they're able to bring in enough cash through new purchases or to manage dividends, things like that, in order to meet the needs of you, the investor, when you need cash. But when a lot of investors need cash at the same time, well, that manager may need to sell shares inside of the fund in order to create cash. And if they're selling shares at a gain, well, then that capital gain is passed on to all of the shareholders. Same thing if just the investment strategy of the fund requires them to sell shares for a gain. Well, in a mutual fund, those gains are needed to be passed on to you, the shareholder. With an ETF, it's a little bit different. ETFs, the company that creates and sells the ETF, the Vanguards, Dimensional Fund Advisors, Avantis, whatever fund company you're thinking about, they actually transact with a middleman. And the way that they can swap shares of the individual investments with ETF shares, just the way that they interact with these other large institutions allows them to create new shares of ETFs and then redeem shares of ETFs without having to sell investments for a gain. And eventually what the structure of the ETF allows to happen is that there are either very little or often zero capital gains each and every year. And so that can be a much more favorable tax outcome if you're holding them in a taxable account. So for that reason, many advisors do choose to use ETFs in taxable investment accounts, although some fund companies have mutual funds that are still comparably tax efficient, so that's not always the case. But there are some important differences in how the actual structure works. And they also carry an annual expense ratio like mutual funds, although most ETFs, I believe, are passively managed ETFs. A lot of them are going to be index ETFs, meaning they're gonna invest in an index similar, or they're gonna invest to match an index similar to an index fund. So their costs on average are going to be pretty low, similar to a passively managed mutual fund. And like stocks, ETFs have those implicit costs to keep in mind, and the explicit costs. So if your broker is going to charge you a fee to sell stocks, typically they're also going to charge you to sell or buy ETFs as well. But there's also those bid-ask spreads that we talked about with stocks and different price effects too. So those are mutual funds or ETFs. Those are really commonly used among, individual investors, financial advisors as well. Me in my own practice, I'm using ETFs primarily, but mutual funds where needed, for example, 401k accounts, things like that. Many financial advisors, including myself, use primarily passive style funds, whether it's mutual funds or ETFs. I'm going to do a separate episode all about passive versus investment management, whether it makes sense to use one versus the other, what are the differences. So stay tuned for that. But those are some of the differences between the two. And one other form of investments common in investment accounts that we're talking about are publicly traded REITs, or real estate investment trusts. A REIT is a company that owns or operates or maybe even finances income-producing real estate across a range of different types of properties. So commercial and apartments, hospitals, medical centers, retail centers, but even things like data centers, cell towers. So some stuff like that you wouldn't necessarily expect. It's similar in concept to a mutual fund because it's one investment trust that owns a bunch of these real estate investments. And to qualify as a REIT, there are certain requirements. So at least 75% of its assets need to be in real estate investments, and at least 75% of gross income has to come from rents of real estate property or interest on mortgages related to real estate, or the sale of real estate. So it's got to be real estate related. It can't be sitting most of its dollars in cash. And they have to pay at least 90% of its taxable income to you, the shareholder, as a dividend, among other requirements. And many advisors, including myself, will use REIT mutual funds or REIT ETFs, so a fund of a bunch of REITs, to invest in REITs across the US or even globally. So we will include that real estate exposure, that real estate portion in our portfolios, as well as stocks, businesses, as well as bonds. So we can look at these different investments. We have stocks, businesses, we have bonds, which is debt. What are the roles of these different investments in your portfolio? Because we're not really talking about just buying them all and looking at them all individually. What we're really thinking about, or at least what I'm thinking about, is how do they work together in a portfolio, in one pot of money, all mixed together over the long term, all towards a particular goal. And the first thing to think about is that there is a direct relationship between risk and reward in investing, and in these investments in particular. Just think about your own practice if you own an optometry practice, or just think of a private practice in general. If you own the practice, you are the stockholder. And if you went to get lending from a bank, of course, obviously your bank is the lender in this situation, similar to a bondholder. And between you and the bank, who has the biggest or the most risk in this relationship? Well, it's you, it's the stockholder. Ultimately, if your business fails, you're going to feel the full financial downside of that. Obviously, you're not going to be able to pay your current bills, but all of the wealth building opportunities are lost with it. Anything you invested, all the time you invested, the dollars you invested into that business are lost. However, from the lender standpoint, they're much more confident, most likely, that they're going to get at least some of their money back. They're in a much less riskier position because even if you go into bankruptcy, your lenders are going to be at the top of the list to get funds back when you start selling equipment and different things like that. So there's a much higher chance that lender, your bank, is going to get their dollars back than you will, the stockholder. However, when you look at the return opportunity between you and your lender, who has the highest opportunity for return? Well, it's definitely you. You have the opportunity to take advantage or to enjoy the full growth of your business over your career, between the profits and the distribution of profits, all of that cash flow that comes with owning that practice that you can either reinvest into the practice or invest outside of the practice. And of course, the growth in the value of your practice that you can potentially sell down the road when you're ready to exit. So you as the shareholder, you take on more risk, but you have the higher opportunity for return over your career. The lender, of course, is just going to get the principal back plus some amount of interest, right? 4%, 5%, whatever it may be, over the course of that loan. And then once that loan ends, their return opportunity ends. So in the same way, stock, business ownership, tends to have higher risk than bonds. That works theoretically, and we also see that throughout history. As a stock owner, your full investment is at risk. If that business suffers, declines, goes out of business, your full investment in that business goes along with it. As a bondholder, though, not only do you have a set maturity, potentially a pretty short timeline, a short maturity before you're going to get your principal back. So your risk connection to that entity isn't perpetual. It's not forever. But you're also at the top of the food chain, so to speak, in terms of who gets their money back in the event of bankruptcy. So there is lower amounts of risk related to being a lender, a debt holder, a bondholder than there would be as a stockholder. And of course, as a bondholder of a government bond, let's say U.S. debt, for example, you're relying on the full faith and credit of the United States. You're relying on the U.S. government's ability to tax its citizens, plus the ability to create and print dollars into infinity. I mean, that would cause a lot of other inflation issues and things like that. But you're relying on the government's ability to do these things that no corporation or person can do in order to fulfill its debt obligations. And that's part of why the shortest U.S. Treasury bills are considered the risk-free rate. The yield on that bill is considered the risk-free rate because it's such a short maturity for such a strong, stable borrower that's usually what's referred to as the investment that has no risk. And when we think about stocks, there are risks specific to each individual company or industry or country, geographical location. And so there are risks specific to those specific companies, and you can mitigate against a lot of that by diversification, properly spreading out your investments among a whole bunch of different stocks in many different industries throughout the US, and not only the US, but of course globally. There are some risks specific to the market as a whole that you can't necessarily diversify away against, but you can at least diversify some of those risks specific to each individual company. Bonds carry their own risks. Bonds carry risk around interest rate risk, meaning that the volatility, the change in price relative to changes in interest rates. When you think about bonds, the price of bonds moves the opposite, inverse to changes in interest rates. So if interest rates rise, you're going to see the price of those bonds decline. If interest rates go down, you're typically going to see the price of those bonds go up. And the reason is if you are a bondholder with a 4% interest rate, and then interest rates go up, and now you can buy an almost identical bond for the same length, the same maturity at 5%, well, why would anyone buy your bond at 4% when they can buy that same bond at 5%? So you would have to decrease your price to where the yield ended up at 5%, to where the yield ended up the same. So that's why prices adjust based on the interest rates based on the changes in interest rates. There's also reinvestment risk. So as bonds mature and investors get their money back, they have to reinvest that capital, that money into a new bond, and it may very well be at a lower interest rate, so they get a lower return. There's inflation risk, meaning that there's a pretty strong risk, I would say pretty strong likelihood that your bonds will just barely or not be able to keep up with inflation over time. There's default or credit risk, meaning that the likelihood or the chance that whoever's issuing that debt, whoever's issuing that bond will default and not be able to pay its obligations. So there's different risks specific to bonds. Part of that will be reflected in the interest rate as well. As we mentioned earlier, higher interest rate can indicate a higher risk debt. But we see this relationship in general between stocks and bonds where stocks have that higher risk associated with them, with business ownership, but they also should, in theory, you should expect a higher return over time than you would with a bond. You should expect a premium for that risk, a risk premium. And we see that work out not only in theory, but also throughout history. You see the actual performance shape that out. For example, when we look at the U.S. stock market, so the Russell 3000 index, when we look at an index of long-term government bonds, and when we look at an index of 5-year U.S. Treasury notes. So we've got sort of a mix of different assets here. From 1979, so going back throughout history, through the end of 2022, the average annual return for the U.S. stock market, the Russell 3000, was about 11.6%. When we look at the long-term government bonds return over that time period, that was about 7.54%. Of 5-year U.S. Treasury notes, that was about 6.36%. So there's definitely a difference over long periods of time between the return of stock investments, broadly speaking, and the return of bond investments, broadly speaking. Of course, this is where I should plug in my sort of standard compliance spiel. Like, this is past performance. It's not guaranteed to be this way into the future. However, the past is helpful to building expectations about how these different investments behave. But we also definitely saw a mix of, we definitely saw the trade-off of risk. And one way risk is looked at or measured is based on the volatility of the thing you own. So the variability or bounciness of the price of the thing you own. Although that's certainly not the only measure of risk, or maybe even the primary measure of risk if you're a long-term investor. it's definitely a measure of short-term uncertainty. How much nonsense, how much ups and downs should you expect within each and every year? When we look at this measure for these three different categories of investments, what we see is that U.S. stocks, the U.S. stock market as a whole, has almost 3 times the measure of volatility or bounciness as 5-year U.S. Treasury notes, which is pretty substantial, right? Quite a bit more volatility, quite a bit more uncertainty in the short term there in terms of what prices will do. Long-term government bonds, although they had returns pretty similar to 5-year U.S. Treasury notes, the measure of volatility for long-term government bonds was actually much closer to the U.S. stock market. So you saw a lot more of this measure of risk with longer-term government bonds. Another way we can look at the differences in the risk between these different investments is the maximum drawdowns or the maximum decline from top to bottom. So when we look back throughout this same period, so 79 through 2022, the very worst 1 year or 12-month period for the Russell 3000, so the U.S. stock market, was negative 43.5% back in 2008. That was the worst 12-month period starting in March of 2008, which is substantial. But when we look back at 5-year U.S. Treasury notes, for example, the very worst return, the very worst 1-year period was actually back in 2021, starting in October of 2021. And that was a negative 11.85%. So still double digits. That was actually the worst. 2021 was sort of through 22. 2022 was sort of an anomaly with the stock and bond markets. But even in the worst case scenarios on record here through this time period, there's still a substantial difference between what you would expect the decline in the stock market to look like versus what you would expect the decline in especially the short-term bond markets to look like. Interestingly enough, we talked about the risk of long-term government bonds. The worst return, the worst drawdown, again, was starting at the end of 2021 through 2022. That was negative 28.7%. So a pretty high amount of uncertainty and risk you're taking on with really long-term bonds, even long-term government bonds. So we should expect theoretically, but we see also in practice, this additional return over long periods of time by owning businesses, by owning stocks versus what you would expect with bonds. And that doesn't mean that every year you're going to see that happen. We see plenty of years where bonds did better than different categories of stocks. We've even seen several chunks of years, longer than you would expect, where certain categories of bonds did better than the certain categories of stocks. So that doesn't happen each and every year, but over long periods of time, you should expect that relationship to continue. Knowing that and keeping that in mind, what is the purpose between these two types of investments? And I would include real estate investments together with stocks, so in this equity bucket of your portfolio. And the purpose of stocks to me, of equity type investments to me, is to drive the long-term returns of your investments, especially above and beyond inflation over time. That is the purpose of these stock part of your portfolio. That's really where you want to take the risk, because that's where you will be properly compensated for that risk. The purpose of bonds, for me in my mind, primarily is to provide stability in your investments, is to provide stability in your portfolio. So because for me, that is the purpose of bonds in an investment portfolio, I prefer higher quality, shorter duration bonds in a portfolio where it's serving that purpose. So those are the two purposes. So that's hopefully a helpful overview of stocks versus bonds versus REITs, mutual funds versus ETFs, and sort of a quick overview of what is the purpose of these two different categories or types of investments in your investment portfolio, in your investment mix. In next week's podcast episode, I want to talk about how do you know the right mix of stocks versus bonds in your portfolio? What is the right mix between the two? And I'm going to talk all about how do you determine that. And so hopefully we'll catch you on the next episode. If you have any questions about anything I mentioned in this episode, or about future topics for future episodes, shoot me an email, Evon, EVON, at optometrywealth.com. Of course, you can check out the show notes to this episode or all the other episodes we've done at the Education Hub on my website, www.optometrywealth.com. And while you're there, you can feel free to schedule a no-commitment introductory call. We can talk about whatever's on your mind financially, and we can talk about how I help and serve optometrists and their families all over the country with things like prudently, properly managing their investments, proactively planning around taxes, and everything in between. And lastly, if you're just not ready to chat, if you're not ready to talk about services, for my optometrist listeners, I'm offering a free financial health assessment. And basically all that means is that you can download the financial planning app I use with clients. You can take a few minutes to enter in your financial information, and I'll review and send you a video explaining how the different financial health scores work, how to interpret them, and an assessment of your own scores, and maybe talking about some next steps. So you can find a link to that in the show notes. And with that, we will catch you on the next episode. Appreciate your time. And in the meantime, take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mendrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.